Hello and welcome to another installment of Modern Business Accounting Principles. Now remember, this book is copyright 1936, so some of its advice may be a little bit out of date. But today we're digging into chapter 8, which is accruals and prepayments, and I'm going to warn you that the content is getting pretty dry and really rather technical accounting. But that's to be expected from an accounting principles book. Remembering the purpose or intention of these books was to teach business principles, accounting principles, etc. So it is a how-to guide, and we can't avoid getting technical. So before we actually dig into accruals and prepayments, the book just deals briefly with the purpose of balance sheets and profit and loss and the difference between them, which is important to understand. So the balance sheet of a business enterprise is supposed to represent its true financial condition on a certain stated date. So balance sheets are at a particular point in time. So if you see a balance sheet for 30th of June 2019, that's the value of assets, liabilities and owner's equity at the 30th of June. It doesn't apply to the 29th of June, it doesn't apply to the 1st of July. It's specifically for the 30th of June. So the profit and loss, on the other hand, or statement of income, covers the period of time between two balance sheets. So if you see a profit and loss statement or an income statement, it's generally a from to, so from the 1st of July to the 30th of June. It accounts for the amount of income received during that period, the expenses incurred, and the amount of profits. And the profit and loss also seeks to explain the causes for change in the net amount of shareholder funds or equity on the balance sheet. So profit and loss is a duration balance sheet on a particular day. So the concept of an accounting period, and this is where we start to move more into accruals and prepayments, is of particular significance in the preparation of both the balance sheet and the profit and loss statement. So a series of balance sheets may be compared to mileposts in the progress of a business, from the date of its organisation through its entire life. These posts are placed at equal intervals, the distance between them being the length of an accounting period. The profit and loss statement is a narrative describing important features of the territory between the posts. Each profit and loss statement is a complete narrative in itself. It begins at one post and ends at the next. So an entirely new profit and loss statement begins at each balance sheet date. So it's just trying to tell us that a profit and loss statement is between balance sheets. A balance sheet this year is directly comparable to a balance sheet last year because they are measuring effectively the same things: assets, liabilities and owner's equity. Where profit and loss describes what happens between balance sheets. So why did an asset increase, liability decrease, and what changes were therefore incurred in the owner's equity or the shareholder's accounts. Now, although we do like to compare profit and loss statements, they're not actually directly comparable. They show trends, they show forecasts, kind of, you see, if you've been growing 10% for the last 10 years, you'd assume that would continue, but it is just forecasting. So you can compare both profit and loss and balance sheets, but balance sheets generally more directly comparable. So because we are comparing and describing what happens between two balance sheets, it's important to make sure the information contained in a profit and loss statement pertains exclusively to the particular accounting period involved. There should be no income or expense items carried over from preceding periods, and none of those for the current period should be left over to be recorded in the next one. However, sometimes it is necessary to adjust prior period items in the current period, but such adjustments should be distinctly indicated on the statements. Now, the next line is particularly true, and it's mostly for big businesses, so accruals, prepayments really are a big business thing. But many of the problems of accounting analysis arise in connection with the attempt to maintain the integrity of the accounting period. So what is the accounting period and why does that apply? So the accounting period, the date, the period between two balance sheet dates, as represented in the profit and loss statement. And it comes back to this underlying accounting principle we call the matching principle. So the matching principle is that the income on your statements should be matched with expenses in the same period relating to that income. Why is that relevant? Well, that's basically what accounting is based on. So if we were to be recording expenses from 2 years ago and comparing them with income from this year, well, the statements are not going to be very useful or valid. So there's two methods of accounting that we refer to when we talk about matching and we refer to statements. And these really do catch a lot of people out there who don't understand what they are. So let's dig into what they are. So the first one, cash basis. Some organizations keep their records on the cash basis. That is, only those transactions are recorded that involve values and that have been completed by the actual transfer of cash. Only transactions where cash has changed hands. In other words, payments of salaries would be charged to expenses of the period in which the payment was made, regardless of the time when the services were rendered. So salaries is a big example when it comes to accruals and prepayments, because salaries are often for 2 weeks or a month, and they're not always contained within an accounting period. So you may work 5 days from the end of June, and then 15 days from the beginning of June, working days that is. And then which period do you record that in? Do you record part of that in June because it applies to June, and part of that in July because it applies to July? In cash basis, we record that in July because that's when the salaries were paid. The book gives us some additional examples about interest, but we will skip past those. So it is argued in support of the cash basis that it is simple and avoids the complication of computing accruals. Furthermore, it is claimed that there are usually about the same number of adjustments to be made at the end of each year, so that if they are all ignored, the books will always be out by approximately the same amount. Yes and no. If your business is growing, that's generally not going to be true, but it is one of the arguments for cash basis accounting. The book goes on to tell us these arguments are not sufficient to justify the maintenance of accounts on a basis that is illogical and produces inaccurate statements of income and expense. It's harsh, and it's not entirely true, because some businesses really, cash basis and accruals basis, would effectively give them the same thing. They don't operate with credit terms, they don't receive items in advance, they don't receive payments in advance, or if they do, they are such a small proportion that it's really not that relevant. And accrual accounting is more complicated. Cash basis is simpler. So that's not an argument, that's a fact. However, the book does try to justify its position. When an executive examines the records of business done by her organisation during any given period, she wants to know the true income and expenses and the financial condition at the end of the period. She cannot be sure of the true state of affairs if the statements are prepared from accounts maintained on the cash basis. As long as you understand the difference, I think you can do an analysis. So, what then is the opposite of cash basis? So the opposite of cash basis is accrual basis or accrual accounting. As opposed to the cash basis of keeping accounts, most business organisations have adopted the accrual basis. Most big businesses, yes, that's very true. So the ATO's ruling on it is $1 million. So if you're trading over $1 million, you must use accrual accounting. If you trade under $1 million turnover, you can choose between cash basis and accrual basis. You just can't flick backwards and forwards. You have to pick one and stick with it. You can change, just not every year. Under this plan, accrual, the records are made to show the result of all transactions as they affect the statements for an accounting period. Expenses incurred in a given period are recognised in the accounts, whether actually paid for in that particular period or not, and the items of income earned during the same period are recorded, whether received in cash or not. And that's the main difference. So accrual accounting isn't so much interested in when cash transfers happen, it's when a sale's agreed, either with a supplier or with a customer. And that's then when we start to record those accrual accounting. So accruals, specifically the adjustments we make, are brought into the accounts after the trial balance for a period has been prepared. So there's a series of steps that accountants take, and posting all the journals and making sure everything's entered, and then we go to a trial balance, and then we start looking at adjustments, which we call accruals. So that's all very fascinating. But the book does give us a little allowance for cash basis. So our criticism of the cash basis for keeping accounts pertain to the records of business organisations. Private business is organised for the purpose of making profit on its transactions and a fair return on the capital invested. In order to utilise these resources most effectively, the businesswoman needs information concerning certain relationships such as the proportion of income to capital and of expenses to revenue. Unless there is a direct connection between the income recorded and the expenses assigned to it, the accounting records are of little value. So it is still really quite harsh on cash basis, and it does have an aspect of truth to it. So if we take the example of a handmade business, if you're buying more supplies than you're using, so if you're stockpiling gemstones or wool or fabric, then you aren't using those to produce income. You aren't converting that supply into sales. So you may have sales of $10,000, but you may have bought $12,000 worth of materials for whatever reason. Maybe you were on a good deal, maybe there was a bargain, maybe your supplier is going to stop producing the item that makes your signature thing. But we have to be aware then that we're recording costs for a period that aren't associated with the sales of that period. So it does make itemising a profit more difficult. And this is something I see so often with handmade businesses when they are first starting out. They're buying materials, they're buying equipment, and all of that is genuinely deductible, and that's fine. But then they get disheartened because they aren't making a profit, and they haven't realised that what they have done is invested in that business, invested in assets, even though we're not recording them as assets, because inventory and equipment in a small business generally isn't recorded as an asset like those tiny, not even registered for GST businesses. So you have to be able to identify when you've invested and when that's using up your profits. It's much less disheartening to realise you've actually invested rather than just you've made an outright loss. The book does suggest that governments, charitable institutions, societies and similar that are not conducted for profit are adequately serviced by cash basis accounting, but I think most tiny businesses, particularly if they're not registered for GST, are fine, absolutely fine on cash basis. So, but please remember, and this is what the book's basically trying to get to, no provision is made in the ordinary recording process for distinguishing between income that has been earned and income received before it is earned, or between expense items purchased and those already consumed, and that's what accruals do, they make those adjustments. Consequently, if the accounts are to be maintained on the accrual basis, it is necessary to examine all the income and expense accounts at the time financial statements are prepared. So there is much more process in here when it comes to preparing accrual accounting, and that's why so many people do choose to use cash accounting for as long as possible. And it is a big change if you're working with an accountant in particular to make a change from cash to accrual. The book goes through some examples, but we're going to skip to the categorization. And accountants, they don't create this fresh every time. They have an understanding of frequent and normal And the most common accruals to look for, prepayments to look for, which accounts to examine, that sort of thing. And I'm going to give you some examples. So there's 4 classifications for adjustments when it comes to accruals and prepayments. And they may be classified as follows. So first, expenses incurred but not recorded. So time waits for no man or woman, so you may have incurred an expense, but you haven't received that invoice from a supplier. So the supplier may have sent you the goods and you're waiting for the invoice. That would be an example of expenses incurred but not recorded, because officially you don't have that source document, you don't have the invoice to enter your expenses. So you can enter an adjustment that says, I have a legal obligation with a supplier and I have the goods, so the expense has been incurred but it hasn't been recorded. This is not something you need to do in cash basis. We are just talking about accrual accounting. So the second example, second classification, expense items recorded but not consumed during the current period. So a big example, and one that most people will understand, insurance. You don't pay normally insurance on a month-to-month basis, but that's how you use insurance on a month-to-month basis. So if you purchase a 12-month insurance period, it covers you for the whole of the year. But when did you buy it? If you bought it in November, you're going to be covered November to the end of October. But your accounting periods are going to be July to the end of June. So your purchase of insurance is out of sync with purchase of with financial periods. So if your insurance premium goes up, or if you change insurers, or if you change your insurance, maybe one year you were doing markets and needed public liability, and the next year you aren't, your accounts are going to be different because you have incurred expenses that haven't been fully consumed in the relevant accounting period. It's very complicated and very dry, like I said. The third classification then, income received and recorded but not earned in the month in which the record is made. This is income received in advance of delivering a service. So if you have a subscription, for example, and there's a discount for prepaying 12 months, then you've received 12 months worth of income, but you haven't delivered 12 months worth of services. The same is true for magazine subscriptions, the same subscription. Often magazine publishers receive subscriptions for a whole 12 months. If they receive them in November, expires October, it doesn't align with the financial accounting period. Then the fourth adjustment, income earned but not recorded. And this is one where people that send progressive invoices will struggle. So they may have achieved 50% of a contract but don't invoice the client until 100% of the contract. They have earned that income, but they haven't entered it in their accounting records because the source document, the invoice, hasn't been sent to the client. So in accrual accounting, they will make an adjustment to recognize that earned but not invoiced income. More examples. And that's what you want in a book that is trying to give you knowledge and learning. So we're going to skip then to the summary. And like I said, this has been a pretty dry and technical chapter. But we're just going to summarize. So the adjustments which have been discussed in this chapter arise from the fact that accounting periods do not exactly coincide with completed business transactions. I think we can all agree that is still true 80 years later. One of the chief functions of accounting is to represent a true picture of the changes in financial condition for a stated period of time. In effort to keep the accounts representing income and expenses in strict conformity with the facts, it is necessary to make a number of adjustments to bring into the records certain accruals and prepayments. It should be noted that for every adjustment in an income or expense account, there is the necessity a similar adjustment in an asset or liability account. In order that these adjustments will not affect the principal classes of assets and liabilities, separate classifications of accounts are used. After all accruals and prepayments have been taken into consideration in the accounts, the adjusting entries may be made and the statements prepared, and this process will be explained in the following chapter. And that is certainly something to look forward to. So effectively, it's just saying that when you make an adjustment, you can't just make it on one side. You can't deduct an expense that you've already paid because you have actually given away an asset to pay for that expense. So you paid with money from your bank account, so you can't just reverse the expense because the expense has been incurred. So we create new accounts in assets and liabilities to offset any accruals and prepayments. It's very technical, and if you are a small business owner using cash basis, this is not something you need to worry about. But I would say what's really interesting is 1936